You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Ibstock, ITV, Reckitt Benckiser, London Stock Exchange Group, Taylor Wimpey, and Tritax. Sam, shall I kick us off with Ibstock?
Yes, our favourite brickmaker. How are they doing?
That's right. So they had the full year results out, and full year underlying revenue rose by 2% to £372 million, which was a 6% rise in volumes, partly offset by weaker pricing. Underlying cash profit, EBITDA, fell by 10% to £71 million, and that was in line with guidance. And the decline reflects inflationary pressures and an unfavourable shift and product mix. Underlying free cash flow fell from an inflow of 11 million to an outflow of 10 million, and net debt was £2 million lower at 120 million pounds. The group is facing a challenging start to the year, but expects modest volume growth in the second half, and price hikes are expected to offset cost inflation, and market forecasts point to a full year underlying cash profits rising by 3% to £73 million. A final dividend of 1.5p a share was announced, taking full year total to 3p, which is down 25%, and the shares were down 3.7% in early trading. In terms of valuation, the group have a market cap of £399 million and trade at 18 times forward earnings with a prospective dividend yield of 3.1%. I thought these results were disappointing. We have got used to disappointing results from Ibstock. I think they've got more headaches that are going to be coming down the track, particularly if we see continued high energy prices, because that's at the core of making the bricks. It requires a huge amount of energy, and I would be worried. I think the other thing is that with rising energy costs, you wonder about what that's going to do to inflation, particularly if it persists. It looks like the bond market is predicting that the Bank of England are going to raise rates, which again could slow down the housing market, and then the demand for bricks also slowing in combination with those rising energy costs is a pretty toxic mix for Ibstock. It's also got a fairly significant amount of debt on the balance sheet, which I think would also be a worry. So I would certainly be staying well clear of Ibstock. What are your thoughts, Sam?
Very similar. I mean, where they say they're expecting price hikes to offset inflation, I'd be sceptical on that, given that they've not been able to hike prices in this year. I'm not sure what's going to change. I would agree when you look at kind of energy costs and stuff, because that's the thing as well. You look at the share price. So it's at just over £1 a share. It's at a 10-year low, down over 50% in the last 5 years. And then despite that, it's at a forward P of 18, which seems quite expensive.
Yeah.
Then, like you say, you look at all those cost pressures. They don't have that pricing power. It's very clear from those results. You think, well, actually, 18, it might be reduced earnings, but there's nothing that suggests those earnings are going back up in the near future.
Yeah.
So, absolutely. Even when times were better, there was almost that argument, why wouldn't you just buy a house builder?
Yeah.
And I just think now you look at it when times are worse and you think, well, why do you need the headache? Why wouldn't you just buy, I know like the house builders haven't done particularly well in terms of the shares, but they're not, the ones we've covered recently, they're nowhere near as bad as this. I probably wouldn't want to touch it for the next few years.
Yeah, absolutely. I think, if there was some major energy shift in the UK and you had a lot lower energy costs, it would certainly make, it would make it life much easier for Ibstock and potentially a more attractive stock. But I think the fact that shift away from fossil fuels in these kind of industries, even though bricks are heavy to import and you've got the import costs, it's difficult to see, how things get better unless there is some sort of fundamental shift there.
It's quite an interesting one, actually, just thinking about it. So when we went to the Fundsmith AGM beforehand, do you remember Flying Finance was talking about, without getting political, if we were to have a reform government, what stocks would do well? And number one on his list was Wetherspoons.
Yeah.
I do wonder, would Ibstock be worth considering for that same list?
You could put a little portfolio together
Yeah.
of yeah. Just thinking what else would be up there.
I
Yeah.
suppose anything with high
Sorry.
energy costs, isn't it? That's what you're
Yeah,
looking for.
it is really. So it's whether I guess
I
anything
suppose
sort of
house builders,
yeah,
because
house
you'd
builders.
think they would get rid of a lot of that red tape.
Yeah, I'm just trying to think anything listed in terms of British manufacturing. I don't think there's that much left, to be honest. So
Yeah, and the ones that there are, the problem is we don't really cover them.
yeah, that's right, and they're not usually on the major market. I think they're probably on the smaller markets, but
Maybe tobacco companies as well. Might freeze tobacco duties for a few years. I'm not sure.
yeah, I
Could
guess
see that.
with the two big tobacco companies in the UK, they're so international that you think
Yeah,
how much of that would actually feed through to them. I have no idea, but yeah, maybe FTSE 250 and smaller for some of those more domestic focused companies, possibly.
yeah. Anyway,
Anyway, it's an interesting thought. Maybe we'll do
yeah.
a special at the next election.
We're open to suggestions as well.
That's right. All right. How are ITV doing?
I thought surprisingly well, actually. So I don't think we've covered ITV for a while, and they weren't doing great last time we covered them. Part of the problem is that their traditional broadcasting business is in terminal decline. Obviously, less and less people kind of watching terrestrial television. There's less advertising revenue coming in as a consequence, and that was the business model. So they've come out with full year results, and revenue rose 1% to 3.5 billion. Studio revenues grew 5%, reflecting strong demand from global streaming platforms. And this more than offset weaker advertising revenue in its media and entertainment business, where the prior year benefited from the 2024 Men's Euros. So it's quite interesting as well. For background, they've got two divisions. They've got media and entertainment. That is what you would think of as the traditional ITV. They've also got studios. The way studios makes money is mainly two ways. The first one is they will produce content, and they will produce that content and then sell it to the media and entertainment division, or they will actually produce content for other companies. So they produce content for like Netflix and Amazon and stuff. So I mean, in fairness, looking at the list, I wouldn't say there's any amazing shows, but like, for example, they produced Blind Date for Disney. They produced Squid Game The Challenge for Netflix, which was like a reality competition, which was a spin-off. So they've got the studios division, and that basically produces the content and then either sells it to the ITV media and entertainment division, or it sells it to third parties like Netflix, like Amazon, like Disney. It also makes money by licensing out shows that it's already got the formula for. So, for example, Love Island, one of the most popular shows. And then, if you were to go to Australia, they've got Love Island Australia over there. And I think some Australian network is basically paying for the license to use that Love Island format that they've already established. So the studios business actually seems quite interesting. So underlying cash profit fell 3% to 531 million, and that was driven by lower advertising revenues. Free cash flow fell from 325 to 187 million, which reflects lower levels of cash generation. Net debt rose from 431 to 566 million. In 2026, ITV expects to deliver good revenue growth ahead of the broader market. Full-year cash underlying profit margins are expected to be at the lower end of its 13 to 15% target range due to an unfavourable revenue mix. And final dividend was announced, which was in line with the prior year. And the shares were up 3.6% following the results. They have been in talks with Sky recently regarding the potential sale of its media and entertainment business. So that would include ITV's free-to-air channels, ITVX, which has been a big driver for growth recently. And the figure being discussed is about 1.6 billion. It's quite interesting because when you look at ITV, obviously it's split between those two divisions. The market cap's 2.45 billion. They've got net debt of 566 million. So if you add that back on, you get a value of 3.016 billion. They'd be getting 1.6 billion for what you'd think of as a traditional ITV business, which is just over half. But studios actually makes up more than half the profits. It's about 56%. My only concern with that would be if studios had to stand on its own 2 feet, how much of those profits that are actually coming from producing content for ITV would disappear once it's owned by Sky. And equally, a lot of that licensing would probably disappear because they don't have that ITV platform to almost test out the shows on. So although I think the price on the surface seems quite decent, I think they'd probably be better sticking with the declining business, because of what it allows them to do with studios. And I think the two sort of complement each other very, very well. Oh, so actually they made Line of Duty, which I have heard of with studios. And interestingly, the sales from the studios division, they're not actually impacted by US tariffs either.
Interesting.
So, yeah, ITVX, that grew at double-digit rates, and digital advertising revenue is expected to grow from 482 million in 2024 to 750 million in the next year. So that's doing pretty well as well. And again, if they sold the traditional ITV business, that would go with it. And I know it's not going to offset the traditional decline, but it does help. In terms of the price, they trade at a forward PE of 10.1. That compares to a 10-year average of 9.1. Although I'd argue it's looking like it's in a lot better shape than it maybe was 3 or 4 years ago. The prospective yield is 6.4%, and that compares to a 10-year average of 6%. I think these results are pretty good, actually. I know the legacy business isn't great, but I think compared to the last time we covered them, I think they've pivoted pretty well. My only concern would be if they sell the traditional business to Sky, I really struggle to see studios surviving longer term as a standalone entity. What do you think, John?
I would agree with that thesis. And I think overall, as a company, for me, it's more the lack of quality. I think you can get much better businesses, even if you're looking at sort of industry kind of related to this, whether it's sort of Disney, for example, that has really valuable IP. It does have a streaming business to it. And by historical standards, it's not that expensive. So I appreciate it's more expensive than ITV, but not that expensive. I'd be looking elsewhere. It's just not a business that I'd want to go near, really.
Should we move on then to a business that you used to own?
Yes, that's right. So Reckitt Benckiser got lots of household names, including Durex, Dettol being some of the most famous. Also got Finish for your dishwasher. They had their full year results out with full year net revenue of £14.2 billion, reflecting underlying growth of 5%. All regions were in growth territory except Europe, which was down 1%. Underlying operating profit rose by 5% to £3.5 billion, ignoring exchange rates, as fixed cost reductions helped to offset the impact of tariffs. Free cash flow fell by 23% to £1.7 billion, largely due to higher restructuring costs. Net debt fell from 7.9 to 6.6 billion, and that was helped by the disposal of the proceeds of the Essential Home business, which have since been returned to shareholders. In 2026, underlying net revenue growth in its core business is expected to be in line with its medium-term target range of between 4 and 5%, and a final dividend of 127.8 pence a share was announced, bringing the total for the full year to £2.12, and that's up 5%. There are also around £900 million of share buybacks that were completed in the period, and the shares were down 3.7% in early trading. In terms of valuation, Reckitt has a market cap of £32 billion and trades at 16 times forward earnings with a prospective dividend yield of 3.9%. I actually thought these results were all right. They certainly weren't sort of shoot the lights out, but I think the turnaround is happening. They're making it a leaner business. It has had some disasters over the last 10 years, and the Mead Johnson nutrition business was one of them. They paid an awful lot for that, and with Chinese birth rates slowing, that was the whole sort of investment thesis. They paid a lot for that, and now that looks like they're going to be selling that at a loss. But I think they are focusing on the key brands. It's kind of a bit like the back to basics at Unilever, doing a similar sort of thing, reducing the debt, which is the lowest it's been for many years now, and returning cash to shareholders. I think they're doing the right things. Would I go back and want to own it at 16 times forward earnings with a dividend yield of just under 4%? Probably not. But I think overall it's reasonable and you could do a lot worse. Sam, what are your thoughts?
Yes, it's fairly interesting. So that just looking at the brands that they've sold in the Essential Home business, I don't really recognise any of them except for Sillet Bang. But even then with Sillet Bang, I do wonder how much of it, not that I've ever bought Sillet Bang, but how much of that is actually just, do you remember the old adverts? It was bang and the dirt is gone.
Yes.
So that's my only association with it from those adverts that they used to have. I don't actually know how well it performs and where it sits in the market, but obviously it seems like the whole point of the sale is they want to focus on the power brands.
Yeah.
We've heard that before somewhere else.
Yeah.
Yeah, I think assuming they actually do try and focus on the power brands, I don't think it's a terrible strategy. I think the price probably looks reasonable. The dividend yield's starting to come back up. I think it's starting to look a bit more attractive. And I think those growth rates aren't terrible. And you'd expect as well those growth rates to actually pick up a bit, because if they're getting rid of the lower performers, there's going to be less of a drag on the growth, hopefully.
Yeah.
So I think for the first time, probably since COVID, really, there's actually something to be optimistic about with it. And I think it's kind of coincided actually with Unilever looking, I would say, a lot less attractive than it has done for a number of years.
Yeah. I'm sure we're going to come on to that. Not this episode, but soon, because there are
no spoilers.
Yeah, well, just to give a bit of an outline, whether the business is going to be split up even further. But anyway, that's something for another time. Yeah, I guess it's whether it's actually attractive when you go out and buy Reckitt. I think one of the other things that is, become clear with that sort of market rotation, some of this of the solid earnings that they do have, and that it's a business that is more AI proof, i.e. all of the things that they sell, they're not going to be replaced by AI basically. So that I think is feeding into it too.
Yeah. But yeah, I think it's looking probably the most positive it has for kind of 4 years or so.
Yeah. Okay then. How is London Stock Exchange Group doing?
I think they're doing really well. You wouldn't know it from the share price necessarily, but London Stock Exchange Group, obviously if you're listening to a UK investing podcast, I'm sure it needs no introduction, but they have reported full year figures, and full year revenue, excluding recoveries, was 9 billion, which was in line with expectations. And that reflects organic growth of 7.1%, with performance driven by broad-based momentum across all divisions. Subscription-led recurring revenue grew 5.9% to an acceleration over the second half. Underlying operating profit rose 14.3% to 3.5 billion, supported by top-line growth and continued margin expansion. I'll just check what those margins actually are. The EBITDA margin has gone up from 48.8 to 50.3, but from a quick look, it looks like a lot of that expansion is since they did the Refinitiv deal. I don't know how many years ago that was now, but they've had it for a while. So free cash flow increased to 2.4 billion, up from 2.2, whilst net debt was at 7.6 billion at the year end. However, that does include leases. In 2026, organic revenues forecast to grow by 6.5 to 7.5%, and free cash flow is expected to exceed 2.7 billion, which would be an increase from 2.4 billion this year and 2.2 billion the year before. So that is going up at quite a nice rate. Final dividend was announced, which takes the total for the year to 15.4% above last year. And then as well as that, there's plans for a new £3 billion share buyback programme. And for context, that is on a market cap of 42 billion. So pretty big figures, actually. Oh, so they bought Refinitiv in 2021. So it's about 5 years they've had that now. And because of that, they are more than just a stock exchange, but as well, they've got the major data and analytics business, which is Refinitiv. And most of the revenue comes from providing tools and services that financial professionals rely on daily. The company also benefits from diversified operations. So in addition to data and analytics, London Stock Exchange Group generates revenues from services like clearing and settlements, which help ensure financial transactions are completed smoothly. In terms of the valuation, they're trading at a forward P of 16.8, and that compares to a 10-year average of 25.2. The prospective yield is now 2%, and as we mentioned, there's some chunky buybacks starting to go on as well, and that compares to a 10-year average yield of 1.4%. In terms of the share price, they're currently at £84.50 a share. 12-month high is £119 and the 12-month low is £67. So as you can guess, the low is caused by kind of the AI concerns. It looks like it's rallied quite a lot actually from that low that was back in February. So it's actually up 9.47% for the last month, but it's still down 25% for the year. I mean, this is a really, really quality business. I think the biggest issue has always been the price. I think with a lot of the data Refinitiv gives, I don't know if that could be replaced by AI, a lot of it. I'd put it in the same bracket as Money Group, where I can see where the concerns are coming from, but it's such a high quality business. I'm not sure a forward P of under 17 with those capital returns. I think it's looking the most attractive since we started covering it, but I'm not sure on AI. But I suppose I don't really have. Obviously, the LSE core business is fine.
Yeah.
It's just that Refinitiv, and I don't know because I don't really use the product that much. That's my concern. What about you, John?
Yeah, I mean, exactly the same, really. It's the Refinitiv and the threat from AI with that. I don't know what sort of moat it has on that part of the business. I think everything else looks great. And at the current valuation, it is tempting to sort of take a punt on that. It's really hard.
I think you'd be going back to like we've done in the past few weeks. You probably want it in a basket.
Yeah, and we've mentioned Nick Train's portfolio because
Does he have that London Stock
he
Exchange?
basically has all of these stocks in one, and he's got that sort of portfolio of stocks. It's got your right moves, it's got your experience, it's got your auto traders in it, and LSE is one of those too. Yeah, and Relics, of course. It's a tricky one. It's a tricky one.
The top holdings are.
I think for me, it's going on the watch list.
So number 1, Sage Group, which we're not hugely keen on. Number 2, Experian, which we do like. And these are not small positions, actually. Number 1, so Sage Group's 12%, Experian's 12%. Number 3 is Unilever at 11.5%. London Stock Exchange Group comes in at number 4 at another 11.5%. Relics is 11%. Diageo 10%. Rightmove 7%. Burberry 6%. Schroders 5%. And then Intertech 3.77%. And the top 10 holdings make up 90% of the portfolio.
Yeah.
I'm not sure I love that portfolio. I don't love Burberry in there.
Yeah.
Probably less keen on Unilever now.
Yeah.
Yeah, I think we'll have to construct our own basket and see if we beat him.
Yeah. Well, I think it's concentrated, and obviously, if it's in good times, if his investment thesis pays off, obviously that could really take off. And they're not expensive, those stocks, certainly by historical standards.
No. There's any point looking at his performance.
We may come back to that. So, Sam, shall I?
Oh, yes. So, Taylor Wimpey, how are they doing?
Yeah, well. So, Taylor Wimpey, one of the UK's biggest house builders. So, revenue was actually up 13% to £3.8 billion. That was driven by UK completion growth of 6% to 10,614 new homes, and average selling prices rising 5% to £335,000. Underlying operating profits grew at a slower pace of 1% to £421 million due to higher operational costs. Free cash flow fell from £162 to £129 million, and the net cash position fell by 39% to £343 million. In 2026, total UK completions are expected to be in the 10,600 to 11,000 homes range. Underlying operating profits are expected to fall to around £400 million, reflecting softer pricing in the order book. The total payout policy remains unchanged, but the mix has been tweaked to include a share buyback component. And as a result, full-year dividends are down 20% to 7.62 pence per share, and a new £52 million share buyback programme has started. Shares were up around 3% in early trading. So in terms of valuation, market cap is £3 billion, and it trades at 0.87 times forward price to book, compared with the 10-year average of 1.36, and it has a prospective dividend yield of 8.8%. I think these results were largely as expected. Things are slowing, though, and the order book as well is being softer. I think short-term concerns are that interest rates may rise as a result of increased energy costs and the war in Iran, and you do wonder what that's going to do to this. Also, the house building, the reforms, the easing of planning restrictions, we haven't really seen that. So by historical standards, certainly Taylor Wimpey looks cheap. I would be bullish on the sector longer term, but in the short term, there are a number of headwinds. And I think, coming into the last 18 months, when you did have a new government, there was a lot of rhetoric about easing up the planning system. We haven't actually seen that yet. So things haven't taken off with the house builders as we might have hoped for. I've held Taylor Wimpey before. I've held Persimmon before. I now have Barrett Redrow. And I think if we went back at all the recordings, I've been optimistic for about 5 years. And yes, had decent dividends in that time. But in terms of the fundamentals improving, I'm still waiting. And arguably, if I'd gone out and invested in a different sector, I'd have got much better returns. So what do I know? Sam, what do you think?
I think these results are pretty good, actually. I'm surprised they've been able to get the selling prices up 5%, to be honest. Didn't really see that in the others. What's the difference in the geography?
I know Persimmon are more northern, Barrett Redrow are more southern, but I think Taylor Wimpey, let's just have a look.
They are struggling on the cost side, which, reflects everything we've seen with Ibstock results, and also suggests that's not going to get any better.
So it is more southeast. So London is 10 to 15%. Southeast, excluding London, is 20 to 25%. So combined 30 to 40. Looking at the southwest, that's 15 to 20. Midlands is 20 to 25. And North actually 20 to 25. So it's a fair spread, although there is sort of southern bias there.
But the northern ones have struggled more to get the prices up.
Yeah.
So that's what it is. But yeah, it's difficult because although they've done well to get the prices up, they're losing it all on the cost side. I suppose you can put them in the mix for the reform portfolio at least. So I think probably the biggest driver for the share price in the next few years, I think it'd have to be a change in government.
Yeah, it's a tricky one.
Do you think someone I know we've been saying this ever since we started the show. You've been saying it even longer. The potential is there.
Yeah.
If someone could just get Britain building.
Yeah, that's right. And so we've had two parties that haven't been able to do it. So who knows what will happen? I guess it's past that.
All right.
Reform pie. Yeah, shall we move on to Tritax? No US company of the week.
So Tritax, company we've covered lots before, but they are a REIT and they mainly do basically big warehouses and distribution centres and stuff like that. Hence the name, big box. It's basically buildings that are shaped like a big box. So they have come out with full year results, and there was a 10.6% rise in full year net rental income to 305 million, with benefits from the UK commercial property acquisition, developments and rental growth more than offsetting negative impacts of disposals. Operating profit grew 6.1% to 281 million, and the portfolio value increased from 6.6 to 7.9 billion, largely driven by the 1 billion acquisition of Blackstone's logistics portfolio. You may remember, we covered it at the time, but basically they wanted Warehouse REIT, they didn't get it, Blackstone got it instead, and then to fund it, Blackstone had to sell them some logistics properties, basically, that Blackstone had. And I think at the time it looked like they'd got a pretty decent deal on that. This resulted in the loan to value rising from 28.8 to 33.2%, but it's still below the target 35%. Vacancy rates remain stable at 5.6%, with increased leasing activity offsetting higher vacancy rates in the Blackstone portfolio. I'd be pretty comfortable with that. I think their properties have historically been very good. And I think with the Blackstone portfolio, I think they will get that down. The dividend was up 4.4% for the year. And basically because it's a REIT, they have to pay out the earnings or 90% or something like that to retain the REIT status, which means that, they don't pay corporation tax. So they're selling lower yielding mature assets to invest in higher yielding development opportunities. And that's how they're going to plan to fund the growth. The merger with commercial property REIT in 2024 is helping because they're selling some of those worst performing properties to free up capital. And as well, they can do the same thing with some of these, probably not the Blackstone properties because they've just acquired them, but I think they know how to operate sort of quality kind of warehouses and stuff like that. So I think that Blackstone, they will either get those vacancy rates down or they will just ditch the properties and get something better. In terms of valuation, they're trading at a forward price to book of 0.83. That compares to a 10-year average of 0.91. Prospective yield is 5%, and that compares to a 10-year average of 4.7%. In terms of the share price, currently at 145p, 12-month high, 174p, 12-month low, 122p, and it's currently at a discount of 20.42% to the net asset value. And I think, for the most part, those net assets are quality. So, yeah, I think it's really attractive. I think since the shares have kind of pulled back in the past month or so, they're down 15%. I think since then, I think it's starting to look more attractive again, because the biggest issue I've had on it is the price, but I think it is one of the highest quality REITs that's listed in the UK. What do you think, John?
Yeah, I like it a lot. And I think at the current price, it's more attractive than it has been for a while. So it's another one for my watch list, quite seriously.
In that case, of the 6 companies this week, Ibstock, ITV, Reckitt Benckiser, London Stock Exchange Group, Taylor Wimpey, and Tritax Big Box REIT, which do you like the most and which do you like the least?
So Tritax would be first, close second, London Stock Exchange Group, and last I would have to go for Ibstock.
Yes, it sounds boring, but I agree with you. I think I really like Tritax and London Stock Exchange. I just think with London Stock Exchange, there's those concerns with AI that obviously don't exist with Tritax. Ibstock as last kind of chooses itself. I think if ITV got rid of the media and entertainment business, though, that would be a firm last after that.
Yeah, wonderful.
Right.
All right. Well, thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.